Good morning, everybody. I'm Dan Hussey from Zaner Ag Hedge, bringing you our strategy of the day update for May 8th, 2020. It has been a while. We've been under shelter at home and work at home orders here at our office, as most of the nation has been. Before we begin today, let's remind everybody that trading futures involves risk and is not suitable for all investors, and leverage can work for you as well as against you. Everything I talk about today is an opinion of my own and not a direct trade recommendation. But let's start talking about some of these markets. Corn, wheat, beans, all finding what could be seasonal lows. We've seen weak exports. We've seen a slowing down in the global economy, and generally markets outside of the equity indices, which have been quite volatile through this COVID pandemic. We've seen all of our commodity prices pretty much remain stagnant, with the exception of energies, which sold off with, obviously with an overproduction of oil globally, and then a complete lack of demand, given that the world pretty much stayed home and shut down. But going into next week, we have WASDE report coming out next Tuesday. This is the first big report to kick off kind of our planting season, outside of course, our progress, which we've been way ahead and setting record pace at getting seed in the ground across the United States. With some good weather this week, it looks like we probably will see continued progress next week, but we will see a chance of frost over the next 48 hours, it looks like, across the Midwest and in some of the northern plains. So we haven't seen as much planting there going on, and obviously a lot of the acres south that are more protected have gotten done, and I think that's, we can't necessarily think that this is going to be a major weather event. However, I do want to take a look today at some of the seasonals, how last year we found a bottom into this WASDE report. Could that, placate into this year? And then, of course, I want to go over our WASDE estimates here today and give everybody a good idea of where we're looking at, as Zaner Ag Hedge is looking at in terms of production and yield going into this year. Well, why don't we start with a quick update of where we've been and what the markets seem to be doing, beginning with July corn. We've been in a proverbial downtrend since the start of the year, which just keeps getting hit with more, bad news after bad news. At the start of the year, we weren't seeing exports. Then we started to see some good export numbers, but then we saw record production in South America, and now, of course, we had a complete shutdown of the ethanol production across the United States, with crude oil prices taking a dive to, we have to go back 40 years to see crude oil prices down to the levels we've seen them, and we saw front month futures in that regard trade negative, which a lot of people didn't understand what was going on there. Since then, there's been a lot of course, discussion, which you may have learned already, but if you haven't, futures prices, they're indicative of a future delivery of a product, not necessarily the spot price or the cash price for that product. So May futures in crude, when they went negative, reflected a cost to deliver the future if it settled negative, because there isn't enough storage. Ergo, you can't just dump crude on the ground and destroy it. There are regulations, and it's against the law, for that matter, to just to pollute and to dump crude anyway. It's not like corn or wheat or beans, which we could just dump in a field and let spoil and be gotten, and there's no need to pay for storage. The delivery and forced delivery of those contracts would have caused people to pay for them to find a home, and honestly pay a premium for taking that delivery. So remember, futures prices at the point of delivery are reflective of the price of delivery of that commodity, not necessarily the price of the commodity itself, which is why a commodity price can actually trade negative in a derivative product like a future. So with all of that being said, there's no worry right now of the price of corn or soybeans going in that far and that extreme, but we are in a downtrend, and we have a market where supply, while we always will have to eat, supply in the near term has come into question, demand has come into question. We've seen slowdowns in the meat processing facilities, which can translate to a slowdown in the kills, and slowdown in the feed and cattle on feed reports, and slowdown of new livestock herds being produced and replenished, which could translate to a slowdown in some feed and residual use. Although we still think that will probably remain firm there, as we'll look at some of our numbers in a minute. Ethanol production did pull the wind out of the sails for corn this year, or to start the year. However, that doesn't mean that corn demand is lost, and certainly ethanol demand being mandated and blending being mandated by government processes there. We will still anticipate, if there is a recovery in crude, if we come out of this pandemic and we get back to work, cars start rolling, planes start flying, ships keep moving, we'll start eating away at our energy stockpiles. Ethanol will continue to get blended, and we will see a recovery if, again, crude can get back above $30 a barrel, back to $40 where we were before this slowdown began. In the near term, however, we are seeing a price a short covering rally begin in July corn, trading 322 and a quarter last. This is the highest level we've been for the month of May, and we're starting to go through and push and retrace the final sell-off we had there into the end of April. Lost my chart. Let's pull it back up here. Now, this 320 area was a good psychological resistance that we're finding ourselves trying to get back above. Above it, we'll find resistance back towards 340. There's some technical levels up there, as well as prior lows from the month of March that we held above, that we would need to chew through on our way back up. I did want to take a look at some of the seasonals, but before that, let's take a look at our numbers here and take a look at what Zaner Ag Hedge is expecting and estimating into next week's WASDE report. So for corn production, the USDA prior here was at 13.6 billion bushels. The outlook here is for 15.4 billion. We're at a 15.8 billion production. And that is, of course, taking, the 178 half average yield over 97 million acres, cutting back on some ethanol production, and keeping that in the stockpile. In terms of walking back on potential usage for next year, meaning that production again will, our end production number will be affected by that. But again, we're looking at, that's where our ending stocks jumped. But production next year, we are looking for maybe, additional acres there, or a slightly better yield. And again, the estimate of 15.8 billion bushels is where we're at. Soybean, we're at 14.1 billion. That's pretty much in line with USDA outlooks, but again, not much is affecting soybean demand, as meal demand is still there. Crush capacity in the U.S. is still pushing maximums. We're seeing record crushes every month now. So domestic demand for soybeans is there. And now that we're starting to see flash sales and hopefully more positive talks with China in terms of them buying our beans, which might become a reality because we have seen record purchasing from South America, which opens the Pandora's box in the idea that, one, are we running out, or South America starting to run out of soybeans, or two, are we starting to see some rationing there that because we've seen port closures and other issues with the coronavirus and COVID pandemic, a slowdown in South American ability to meet those Chinese orders could, circulate some of that purchasing back to the U.S. And we're seeing the flash sales come down the tape from the USDA. Every day we're seeing, today we saw 120,000 tons, which is a nice amount. When those start translating to exports, that's when we know that switch has flipped, and we're starting to see now that global demand for soybeans come back to the United States, which, again, next year we're looking at an ending stock number potentially of about 580 million bushels for soybeans, which is quite tight when we get down to our stock-to-usage ratio. That is still down in the, honestly, somewhat bullish stock-to-usage ratio for soybeans. Corn, on the other hand, again, 97 million acres, with 178 half per average trend yield, or just hitting trend yield, will be at a 15.8 billion bushel production. Our ending stock number here coming in at 3.5 billion bushels, and that we are somewhat conservative on the ethanol cutback there, because we do believe we will see kind of a V-shaped recovery in energy consumption. But obviously, ethanol is hurting now. But the second I think we can get back to crushing corn and producing ethanol, we will. It's a matter, and of course we have government mandates and things protecting some of that production. But we are going to see potentially a larger ending stock than what the USDA is looking at here, and we're not going to be shocking too much to the upside, because again, this is just following trend yield over the 97 million acres that the USDA has talked about, gets us to about a 3.5 billion bushel carryout. And again, there are some, and I think it's only about 175 million bushels a month or so of production in there from ethanol that we could be taking out. Well, if you only take out a couple months of that, we're not talking about shaving 500 million bushels here yet. We've got to get through 3 to 4 months before that occurs. So before that type of demand needs to be added back, taken out. So we are a little conservative in terms of how much we reduced ethanol demand on this balance sheet. But again, I think we will see. We'll see where we land next week. But if the markets have priced in this level, this type of balance sheet and expectation, we weren't. This brings up and reminds me a lot of last year. We talked about a balance sheet where we weren't. Yes, we had some weather effects and weather scares this time of year, but the reality is we got a lot of acres planted, and there were lots of talks of prevent plant, but we still saw some good price rationing. Which I want to talk about the corn seasonals, because if we can talk about, okay, well, there's a good reason that maybe we've got a bit of a range in corn between 320 to 310. Maybe expand that out between 330 and 310 in the July. But if we start to get above 320, then above 330, now we're talking about maybe starting the type of reversal against a much larger downtrend that we've been in, by the way, that began around 420. A reversal of that could take us back to 50% of just that is up towards 360. Retesting of the floor we were at up into November and into the start of the year was up around 380 in corn. So if we could get back to 360 to 380 in terms of short covering or some kind of price rationing this year, how realistic is that? Does it look like years past? And we'll take a look at that in a moment. I think that July corn coming down and testing $3 here was effectively testing the idea of corn production, or the price of corn without ethanol as an industry and demand. Corn as a product was about a 250, 275 crop before ethanol. Factor in a few years of inflation that we'd have to go back and to compare price to. Testing above and testing the $3 psychological level is big. Now, into next week's report, we could see one more dive and one more flush out into lows, certainly. But will that, be a capitulating low that reverses? If it is, and it starts to give those signals, that'll be something we're covering and talking about. But for right now, we're starting to see, I think, a bottom potentially try to form. At least the market's showing some short covering against the trend that we've seen down into this report. Maybe profit taking from funds that are short, from the consensus has been for corn to go lower, and now that we also see crude oil starting to get a little bit of a reaction here. I guess I could bring up that chart real quick over here to at least give us some comparison. You can see our June crude here, hourly chart. We've at least started to come off of the low, not exactly enough to, I think, make us feel totally confident. But if we are able to press back in crude prices back towards, bring up a daily chart. There you go. This is the gap I wanted to show. And there it is. So crude oil, I've got a chart of the June crude up The 35 to 41 area, really it's this 41.60, call it a 42 gap. That level in the June crude, I am expecting the market to eventually retrace back to that level. Gaps typically fill in markets. Now, it doesn't mean it has to. We could go negative on June crude for all we know before it gets back to that level, if it ever does. And of course, this isn't just the June. If we look at, July crude, you can see the gap for July crude's up around 41. At some point, I expect one of these contracts to close that gap, 41 to 42 on the crude. And I believe it's that level, and it's in my opinion that it's that level that represents, us getting back to some kind of level of normalcy for ethanol in the short term. And I think that would take a lot of pressure off the industry as a whole, and certainly take a lot of pressure off of corn, which we've seen over the last several weeks has taken quite, a hit. So let's look at the seasonals real quick for corn, because again, I think that we could be finding some kind of bottom. We're breaking trendline resistance. We're starting to head higher in the short term, testing resistance. That's important. But what did we do over the last few years? And if we go back the last 5 to 6 years here, and look back the last, the blue line here is July of 2020 crude, so it's corn. While the green line there is a 6-year average, and you can see that right about now, over the last 6 years, we've averaged a price of beginning around 360 and ended around 380. So there was a price average increase of around 20 to 30 cents. In corn between July and, this period of early May and the end of contract in July. And if we go back and look, adding last year in first, you can see a sharp rally last year from 350 up towards 450 corn. This is all price rationing this time of year as, we start to weigh in not only this year's production, but of course how demand is eating through the pile of last year's corn. That plays into the stock to usage ratio, and of course affects the seasonal spread between old crop and new crop. And looking at this old crop corn, we see that last year we had a big rally. The year before that, we actually had a bit of a sell-off. That is the one outlier that we'll leave in the chart. I'll take it off the chart for now, but we'll come back and add it in. You saw 3 years ago we had sideways to up markets. 4 years ago we had a nice rally up into the start of July before the market fell apart, and of course a little more sideways there. So the point is that there is at least a seasonal that says we should see some kind of price rationing between now and July in corn. We'll see if that happens this year. And I'm merely pointing out that the seasonal is there for the last 6-year averages, right? And we could potentially be putting in early signs of a reversal from a technical perspective on a chart. We're making higher highs and higher lows for the 3rd day in a row now. We're starting to trend higher for the month. We're still inside the prior month's price action, but we have clear lines in the sand and resistance that we're starting to press above. And I think a close above 320 today, and certainly above at the highs of May here around 322 is a good sign. We'll be onwards and upwards to test 330 as resistance. And above there, I think that's where the green light for the market in a short covering rally would be towards 360 to 380 for the rest of this marketing year potentially. Now, that's great for July corn, but what about new crop corn? Because new crop corn here, December corn, trading up back towards 340 right now. It's been about a 340 to 320, 325 range here for the last several weeks. And I'm anticipating that new crop corn could see a move back towards, $3.90 to $4. And if we take a look at the seasonal for new crop corn here over the same, basically, 6-year look back and average. We're going to hide all the others here real quick and just look at the seasonal average. So we have a seasonal period of bearishness for it. Before we do typically find in that new crop contract, December corn does find a low. Over the last 6 years, we found a low averaging around 380. and headed back up to $4. So we saw that 30 cent price appreciation in new crop corn over these last several years. And if we start to add them back in, you can see very sharp rally last year. Took us an entire dollar higher, excuse me. 2 years ago, we still headed higher over this period, even though we saw a sell-off last year, or 2 years ago, in that July contract. New crop corn, Jimmy crop corn, and I don't care. New crop corn did in fact rally until early June before selling off. And that's where that July NOV spread widened out over that period in that year as well. Adding in 3 years ago, you can see here a slight rally from $3.80 to $4. So all things considered, there is and here you go, 4 years ago, rallied from $3.68 up towards $4.50. And again, 5 years ago, hard to tell, take out all the others. There you go. 5 years ago, it rallied from 360 up towards 450 again. So I'm looking at this time of the year being a seasonal low. And again, that green line here is the seasonal chart for corn. And I'm looking for that potential bottom to occur. Okay. All that being said, soybeans find themselves in a bit of a range as well. We've been here, done that, talked about ranges in soybeans so many times over the last year that I feel like we're starting to go crazy with it, right? But 860 or 850, it's actually 856 half, call it, down to an 831 half low is the current range for soybeans. I was hoping to see us above or below this range into the SWASD report, but we may need the SWASD to get something done. And I am fearful that we'll see this range consolidate and break lower now on a third test and failure of this 356 area. So if we can't break out, if we do, great. We'll be onwards and upwards towards 377, or excuse me, 877 and $9 again, in my opinion. But for right now, we're caught in a bit of a range. And while exports continue to pick up, while we're seeing some flash sales, there's still such a black swan type of event going on here with the pandemic that we're not really sure when the whole world is going to get back to normal, and when and if we're going to see China, really come in and buy. So let's look at the seasonals for at least soybeans here for a second, and then we'll get going for the weekend and call it at that. So July beans here. Certainly the well, apparently it doesn't want to work. Let's look at. Well, if we're not going to be able to get the chart up, unfortunately, we'll come back and we'll look at these next week. But what I was going to be pointing out was something similar, that we had, a seasonal low that forms this time of year, right? How big was it? What can we expect this year, this go around? But these are all topics, again, we're going to get back into the swing of things and be talking more about next week and continuing on here as we start to get back to producing a little more content for you. So, all right. So, again, soybeans here. Geez, let's just talk about November real quick, and then we'll call it a week. 860 to 840 range here for the November beans. Again, I am expecting. Okay, here our seasonals back. Let's do that because I did want to talk about this. Perfect. Okay. So the 4-year average here is quite flat to sideways for the soybeans, and that's just the 5-year average is quite flat to sideways this time of year for the November beans, unfortunately, and that is because of just how it happens to align with marketing years, globally. But we did, and we still see from this point in the year, still see some price rationing that occurs, and in years past. Last year, we saw a rally from about $8.30 in the beans up to about $9.40, so a full dollar. The year before that, we actually saw a bit of a price decline this time of year, and that's something we need to be wary of. And that's a part of the reason I'm a little weary of finding this resistance for a third time on this chart and being unable to, break out. We don't have to go that far back to see a similar range that we are holding in the soybeans. You have to go out to a 4-hour chart, I guess. But if you remember last year, we had that whole range that we eventually broke down. Here you go, up here. 3 tests to try to break out of 980 before eventually failing and breaking down. Now it's on a smaller time frame, but a very similar type of structure. 3 tests, this time of 860. And failing to break out of it this time does worry me. And because we don't have as strong of a multi-year average for soybeans right now, and that if anything, price tends to trend maybe sideways then to down into next September over the last 5 years, without a big change in Chinese demand. We're, doing the same thing over and over again is the very definition of insanity. So not being protected against soybeans here, I think, is silly, even though our numbers do stay and the stock to usage ratios do say we could turn a little bullish until that demand comes in and proves itself from China, and that secondary market in South America keeps feeding Chinese demand. It's really hard for our beans to be price competitive when the dollar is so strong. So I guess with all that being said, I'll close today. We'll take a look at one last thing, the dollar index, which we trading at 99.70, very strong here in the dollar index. The market has been floating and trying to stay above the 100 mark. This is the highest level the dollar's been in decades, and being above 100 is almost unprecedented right now, given the amount of quantitative easing and how low interest rates are. So if this starts to roll back over and we see a reversal of the dollar, which I think below 99 could start to happen, we could see a pickup in our export markets, and hey, we would have something more to talk about. But with all that being said, have a great weekend, everybody, and we'll be back with you next week. And as price action develops, keep an eye out for the WASDE report next Tuesday. And again, we'll be looking out for some interesting production numbers there, with our estimates of 15.8 billion bushels production total for corn and 14.12 billion bushels for beans. That being said, everybody, have a great weekend, and I'll be back with you next week as price action develops. Take care.